Hi everyone. Now in this session we'll revise reading number 4 of financial statement analysis, analyzing balance sheet, and this is exam focused revision. So I'm assuming you understand this concept or chapter broadly, and here we will mainly touch on the key points. Okay, I'm not going to give you any detailed explanation in this reading. Also, no calculations. We will mainly focus on the bullet points which are very important or which you should remember for the exam. Okay. So if you find this chapter difficult, then watch this video multiple times. I'm trying to keep this video as short as possible so that you can have the multiple revisions before your exam and save your time. So watch this video multiple times so that you can remember the content in the exam, right? So let's start with the first part of this chapter. This chapter starts with the intangible asset. The learning objective is on the intangible asset. Now, what is the intangible asset? Intangible assets are assets which have two properties. The first property is the non-monetary. Second property is the lacks physical substance. So we have tangible and intangible. Tangible simply means you can touch and feel. Intangible means you can't touch. This means the lack of physical substance. So this is the very important property. And also non-monetary. The asset should be non-monetary. Monetary asset and non-monetary asset. Monetary assets are assets which can be easily converted into the cash. For example, fixed deposits or certificate of deposits, or some securities which can be converted into the cash which has a ready-made market or readily available market. So that's why, because this is non-monetary, the intangible assets are non-monetary, the securities are not intangible asset is the point you have to remember, must remember point. So securities are not intangible asset. This means the securities are tangible asset. And why? Because intangible asset covers the non-monetary. So there are two properties for the intangible asset, non-monetary and the lacks the physical substance. Now, in intangible asset, we have two subcategories. One is the identifiable, one is unidentifiable. Identifiable means can be acquired separately. For example, the company's brand name, trade name, patent, know-how, all these are the assets, intangible assets, which can be acquired separately. If you want a patent from the company, you can purchase it, right? If the company is ready to sell it, still you can purchase it, right? So if you can separately purchase that particular asset, then this will be the identifiable intangible asset. Remember, intangible and identifiable. So intangible, identifiable asset which can be acquired separately. Example is the trademark, patent, and so on. Then we have the unidentifiable intangible assets. So unidentifiable intangible assets are which cannot be acquired separately. The best example for this asset, for this category of asset, is a goodwill. Okay. Now, if these assets have finite life, then we will amortize it. Same like the property, plant, and equipment. We will use, instead of depreciation, we use the word amortization here. And if the asset has an indefinite life, for example, the goodwill, then there is no amortization. We won't amortize these assets, but it must be tested for the impairment at least annually. This is a point you have to remember. Indefinite life assets, intangible assets should not be amortized, and it should be tested for the impairment, that is a decline in value or loss of value. It should be tested for the impairment at least annually. Now, identifiable asset gets two treatments in IFRS and the US GAAP. First, if the identifiable intangible asset, remember we are talking about the identifiable and intangible asset. Okay, identifiable intangible asset gets two treatments. First treatment is if the asset is purchased, then in IFRS you can use the cost model or revaluation model. In the balance sheet, this asset will reflect as the cost model. You can use the cost model or revaluation model. But if you want to use the revaluation model, then there should be active market for that particular asset. If there is no active market for that particular asset, then revaluation model is not allowed. Only the cost model is allowed. Okay. And this is for the IFRS. In US GAAP, if the intangible asset is purchased, then only cost model is allowed. No revaluation model under all circumstances. Okay. No circumstances can be like where you can use the revaluation model. This is a point you have to remember. Now, this is the first category. If you are purchasing the intangible asset, I'm saying intangible, but remember we are talking about the identifiable intangible asset. Second category is the internally developed or created assets. Okay, intangible assets. If the asset is internally created, so internally created assets generate from the research and development or maybe the marketing expenses, right? So here our focus is on the research and development expense or research and development category. If the asset is internally created, then research and development must be expense. So here we have two expenses: research, the research period, development when you are developing the product. So research and development both should be expensed in US GAAP. In US, I'm repeating statements again and again so that it sticks in your mind, right? So it is not like I'm not wasting just like time just like that. Okay, so repeating some statements which can be confusing in the examination and again and again. So make sure you listen to the repetition also. Now the US GAAP, if the research and development expense is there for the internally created assets, then it should be expensed in US GAAP. But in IFRS, we give different treatment for the research and development. Now we separate the expenses. Research expense compulsorily expensed. Okay, so it is compulsorily expensed, but the development expense can be capitalized, but it has to follow certain conditions. In ideal condition, the development expense will also be expensed, but at the option of the management, it can be capitalized. And what are the conditions for capitalization? If you want to capitalize it, then the conditions are there should be technical feasibility for that particular product. Once you develop the product, there should be technical feasibility. Then there should be available market for that product. You are coming up with the very amazing medicine, okay, for which there are no patients available in the world. Then obviously there is no market available for that that particular intangible asset, right? So you won't be able to capitalize that particular asset. You have to expense it. So first point is the technical feasibility. Second point is market availability for the product. And third point is the company has intention and resources to complete and sell the product. Okay. Remember, company has intention as well as resources. Company has intention, no resources, not allowed. It will be expensed. The development expense will also be expensed. But company has no intention and resources, then also. Okay, so both should be there. Intention and resources. Intention as in the willingness, resources as in enough funds, infrastructure, and so on. And to complete the project and this sell the product. The company wants to sell the product. If the company is like, no, we are not planning to sell the product, so can we capitalize it? No, you are not allowed to capitalize it if you don't have any intention to sell. And all of these three conditions should be satisfied. Okay, it is not just like one condition should be satisfied. Now, IFRS versus US GAAP, expensed as incurred. These are the expenses which must be expensed as incurred under both IFRS and the US GAAP. Startup and training costs is applicable for the plant and equipments. Okay. Then the administrative overheads, then marketing cost, then relocating and restructuring, reorganization cost. Okay. Reallocating and reorganization cost and termination cost. If you are terminating the operations, then that cost should also be expensed. So all these costs will be expensed compulsorily in IFRS and US GAAP both. Now, next discussion is on the goodwill. Now we have two types of goodwill. First is the accounting goodwill and second is the economic goodwill. Let's finish the economic goodwill first because we have just one point to discuss here. So economic goodwills are goodwill which is based on the future performance. It is not recognized in the balance sheet. Remember this. Economic goodwill is the general term used for the company's future performance. So economic goodwill is based on the future performance, not reflected or won't reflect in the balance sheet. Remember, always remember this. So this particular part is gone. Now the accounting goodwill. Accounting goodwill is the outcome of any acquisition where company pays more price to acquire assets which has a, or net asset which has a lesser value. Okay. So if the company is paying say $100 for the asset worth 70, this is net asset. Remember the asset minus liability. And here we are, the acquisition is not of the some plant and machinery. This is full acquisition of the company. Okay. In this case, 30 will be the goodwill. Very simple to understand. So that's why we call this as accounting goodwill. So this accounting goodwill is based on the past acquisitions only. This is the only way goodwill will reflect in the balance sheet. If the goodwill is internally generated, company spends a lots of expenses on the marketing and say, these are goodwill. No, this is not allowed. You have to expense it. Internally generated goodwill should be expensed always, no matter how much you are spending. But if this is outcome of say past acquisition, then that goodwill will reflect in the balance sheet. Okay. Now the formula for the goodwill is simple. The purchase price minus the fair value of the net asset. Fair value of the net asset as in you take the company, you are acquiring that company. Now for that company, you will take the asset fair value, not the book value. Fair value of the assets minus the fair value of the liability. Asset minus liability, whatever is the value, is the net asset value, which is fair value of the net asset. And purchase price minus the fair value of the asset. net asset. And remember, to generate the goodwill, the purchase price should always be greater than the fair value of the asset. Now, what if the purchase price is less than the fair value of the asset? For example, you are paying $60 for the net asset value of say $80. Okay, so you are paying $20 less. So we won't call this as goodwill. This is the bargain purchase. The term used for this situation is the bargain purchase. We are not concerned with the bargain purchase part. We are mainly concerned with the goodwill here. Okay. Now, remember the formula for the goodwill: purchase price minus the fair value of the asset. Then, if the goodwill is internally generated, then goodwill is expensed always. Because goodwill has the indefinite life, it is not amortized, but it is tested for the impairment. Okay, it is tested for the impairment. Now, when the goodwill impairs, the value of the goodwill will obviously come down. Loss will be booked in the P&L, and obviously because this is just a figure in the balance sheet, there is no cash implication. There won't be any effect in the cash statement. This is what you need to remember. Remember, goodwill should be tested for the impairment at least annually, which we already discussed, right? Now, the financial instruments discussion, this is the third part of this chapter. In the financial instrument, we have to mainly focus on the classification and the measurement of the financial instruments. Here, I won't dive deep into the financial instruments part because first, this particular part is very difficult for level 1. And anyway, the financial instrument we will discuss in the CFA level 2 also. The detailed discussion is in the level 2. Here we just have just the overview. So I would recommend you to try to memorize the content instead of somehow trying to understand it, because you don't have enough material to understand in the CFA level 1. Okay, so discussion is not complete in CFA level 1. That's why if you think you are unable to understand this part, it is not your mistake. This is the curriculum's problem. Okay. In level 2, you will automatically understand. Don't bother about it, right? So let's start with the first, the financial instruments, the basic understanding. Financial instrument is the contract which gives the rise to asset for one entity and liability for the another entity. Derivative contract is a good example of the financial instrument where there is asset for one entity and liability for another entity. So example is this only. You can also take the example of the bonds and other securities also. Now, the measurement basis. There are 3 measurement bases: historical cost, amortized cost, fair value. Don't bother about how the exactly each method works. Just remember, historical cost, simply you are carrying it on the historical cost. Amortized cost is you are amortizing it. Fair value is you are valuing that security or keeping that security in the books at the fair value. What is the fair value? At the balance sheet date. Very simple. Okay. So historical cost is mainly applicable for the unlisted equities and loans and notes receivables. Unlisted equities and loans and notes receivables. Okay. Then amortized cost is used for the held to maturity securities. Held to maturity securities, in simple terms, it is you have those securities in your balance sheet so that it, like, you want to keep it for the maturity. Okay. And once it matures, you will get the principal back. This is mainly applicable for the debt securities, where the interest of the investor is in earning interest and then returning or getting the face value back at the maturity. So if the asset is held to maturity securities, then there will be the amortized cost. And fair value is applicable for the trading securities. If the intention of the investor is to trade the securities, trade as in simply means the buy security, and whenever you get the fair price or higher value, you will sell it. There is no intention to hold till maturity, right? So trading securities will be treated at the fair value. Available for sale securities will be treated at the fair value or measured at the fair value, and derivatives at the fair value. Then the classification. Now in classification, we have 2 terminologies or different set of terminologies. In IFRS and the US GAAP, you have to remember these terminologies for the IFRS and the US GAAP. And here, I'll start with the US GAAP terminologies because these terminologies are easy to understand. And if you combine it with the IFRS terminologies, you will understand exactly what's happening in the whole setup. Okay, now see this. We'll start with the US GAAP terminologies for the classification. How these securities, we have, like, company will have multiple financial instruments, right? So how each financial instrument can be classified. First category is held to maturity. Easy to understand. The company is holding that particular security with intention to hold it till maturity. Now remember, no one knows the intention of the company apart from the management of the company. So management decides like, is the security held to maturity or available for sale or held for trading? Okay, this is what the company has to decide. And if company purchases security with intention to held to maturity, then there is no as such restriction on the company that no, because you just categorize the security with held to maturity categorization, now you can't sell it. Not allowed. Okay, so not allowed as in company can sell it. You can't put the you as a regulator can't put the restriction that is you can't sell it, right? Company can classify it. Once the company classifies, there are different treatments. Now see this. First category is held to maturity. The securities which are classified or which securities which are held to keep for the maturity, mainly to earn the interest income or the dividend income from that. Now, next category is the available for sale. There is no outright intention of like selling that security, but security is available for sale. Okay, so it is not for the trading outrightly, but there is the available for sale category. Okay, if we get the price, we will sell it, but as such intention is not the trading. I'm just dumbing down the discussion. Please note here, this is not the exact meaning of available sale. In technical terms, it is slightly different, but here I'm just giving you the idea so that you can remember it for the exam. And here you're not like, this exam is not for the like accountancy exam, right? So you're not going to become the accountant, you are the analyst. So this is for the accountants, like to understand each and everything in detail, right? Now see this, available for sale security. Now next is the held for trading. The intention of this security is the trading only, outrightly trading. Now, this is the US GAAP terminologies. For similar set of classification, we have IFRS terminology. So IFRS uses different terminology, US GAAP uses different terminology. In IFRS, this held to maturity is known as or called as amortized cost. Okay, this is the classification, remember. This is amortized cost. Next classification, which is parallel to available for sale, is FVT OCI, fair value through the other comprehensive incomes. Okay, fair value through other comprehensive income, FVT OCI, or you can also call it as FVOCI. Okay, so depending on like what terminology you follow. So this is FVT OCI. This is for the available for sale, and this is fair value through P&L. This is held for trading. Okay, so the parallel of held for trading in the IFRS is fair value through P&L. Now, as the word suggests here, now if you combine each, you will get the understanding. Okay, so what's happening here? So held to maturity securities are amortized or kept on in the balance sheet with the amortized cost method. So its premium or discount will be amortized in the balance sheet. How it's done, don't bother about it right now. This is not a discussion. Just remember, it is amortized. Okay, and amortized cost is the original issue cost, original issue price minus the principal payments, whatever is the principal return till this particular point, then plus minus discount or premium. If there is a discount, then it will be the security will be amortized by adding value, considering the interest cost, and if it is at the premium, then it will be reduced. Okay, so amortized cost will be reduced. Then minus impairment. If there is any permanent impairment, then that will be considered here. Okay, so held to maturity, amortized cost, this is the treatment. Then available for sale, the parallel category for this is a fair value through other comprehensive income. As the title suggests, available for sale securities, I am combining it. Okay, so this is not the way this categorization is provided. Okay, so I like when I prepared or read this, I realized like if you combine both the terminologies, you get the complete understanding of what's happening inside that particular classification. So in this classification, the securities which are available for sale are treated at FVT OCI, fair value through other comprehensive income. This means this security will be carried in the balance sheet at fair value, and unrealized gains are coming through other comprehensive income and not in the P&L directly. Okay, now remember, we are talking about the other comprehensive income, other comprehensive income, okay, and not the P&L. So after P&L, there will be other comprehensive income. And here we are talking about the unrealized gain, and we are not talking about the realized gain. Realized gain means dividend received, coupons received. These are realized gains. Realized gains, irrespective of whatever is the category, will go into the P&L. So it doesn't matter it is FVTOCI or FVTPL. Realized gains will always land in the P&L. For the unrealized gain in the available for sale security, it will be in balance sheet. It is fair value treatment, so it will be carried at the fair value. And for unrealized gain, it will come through other comprehensive income and not in the P&L. Now, held for trading, also known as a fair value through P&L in the IFRS. For these type of or classification of the securities, we will carry the securities in the balance sheet at fair value, and for the unrealized gains or losses, the treatment is in the P&L. Unrealized gains, simply this means the increase in value or decrease in value. So you have these stocks or equity, this equity price increases, but you're not selling it, so gains are not realized yet. So that increase is the unrealized gain. So in the FVT OCI, unrealized gain will go to the OCI. In FVT PL, unrealized gains will go to the P&L. Very simple, right? So is it to understand? And just remember the parallel categories here. And then for the realized gain, in both the cases, it will go into the P&L only. Okay. So I hope this confuses a lot for to the students. I hope like this got sorted for you. Now, similarities and the differences in the IFRS and the US GAAP. Point to remember. First of all, held to maturity. Held to maturity category is for the loans, debt, unlisted securities for which the fair value cannot be determined. So if the fair value of the securities cannot be determined in the unlisted securities, loan and debt, then it will be carried at the historical cost, amortized cost. These are the same thing. Okay, at historical cost, treatment wise it is same. So at historical cost and the amortized cost or amortized cost, and this for the and classification will be held to maturity. Available for sale. Again, the debt securities, that is, and remember, both the treatments are same. Okay, so in IFRS and US GAAP, the treatment is same in first situation and both second situation also. Now here the available for sale debt securities, that is collect interest and but it can be sold. Simple. This is the meaning of available for sale only. So this will go to the FVT OCI, fair value through other comprehensive income. Everything is explained in this like title only. Available for sale, FVT OCI. What is the meaning? This is for the debt securities. Remember, this is mainly for the debt securities where the intention is to collect the interest, but if the opportunity comes, it can be sold also. That's why we are calling it as available for sale. Now, the IFRS and US GAAP. Now here in red, we have the differences. These are the similarities. Remember this. IFRS and US GAAP. Now, IFRS provides the irrevocable choice for the equity securities. Remember, this is only for the equity securities, not for the debt. Debt is covered here. Debt security is going to FVT OCI. Now, for the equity securities, IFRS gives the irrevocable choice. That is, you decide in the beginning, then you can't change the classification later. Okay, so this is the option available for the equity securities. And what are the options? So either it can be to account for using the FVT OCI. Okay, so as per the IFRS, it can also go into the FVT OCI. Remember this. And then second, in US GAAP, no available for sale for the equity. Just a second, there is a correction here. Yeah. Now in the US GAAP, there is no option for available for sale for the equity. Remember, these are the parallel categories. FVT OCI and available for sale is the parallel category for IFRS and US GAAP. So same option is not available here in US GAAP. Now, next is the IFRS. If the financial asset do not fit the other two categories or classifications other than the FVTPL, then you can pull this in the FVTPL. This means it is not suitable for the amortized cost, not suitable for the FVT OCI, then pull it in the FVTPL. This option is available in the IFRS. Okay. Then in IFRS, irrevocable choice is also available for the financial assets to throw it in the FVTPL. Okay. This is for the financial assets, and for the US GAAP, this option is not available. Okay. So I hope you got the idea. You have to mainly remember this, and understanding part is in the level 2. Don't bother about understanding it in the level 1. Now, next is the non-current liabilities. Non-current liabilities. Now, in the non-current liabilities, first we have the long-term financial liabilities. Long-term financial liabilities. If these financial liabilities are not issued at par, not issued at par means either at the premium or at the discount, then at balance sheet or in balance sheet, this will be carried at amortized cost, and the premium or discount, what is the situation? Because it's not at par. So premium or discount is amortized through interest expense. It is amortized through interest expense. The point to remember here. Then for the deferred tax liability, we will discuss this in the deferred tax asset and DTA DTL chapter, the taxation chapter. Just for like here, just remember this. The tax payable in the future, this DTL is the outcome of the tax payable in the future due to the timing differences in the financial accounting and the tax accounting. Okay. DTL is equal to tax expenses are higher than the tax payable. Okay. And here simply means the tax expense should be higher than the tax payable. The difference of tax expense minus tax payable is your DTL for that year. Then common size balance sheet, you understand what is the common size balance sheet. So all the balance sheet figures are converted into the percentages, but of what percent, like what is the basis for conversion of the percentage? It is percentage of total asset. Remember, in P&L, we use percentage of revenue. Here in balance sheet, we use the percentage of total asset. Percentage of total asset. This is the point to remember. Some students get confused in the exam, like, is it a total asset or net asset or like what? Okay, so remember, this is the total percentage of total asset. All the items in the balance sheet are simply expressed as the percentage of the total asset. You understand this structure already. Now, the balance sheet ratios, like say, I'll just tell you, like if you get question on this in the exam, expect fairly simple, like the plug and play question. Okay, but in plug and play, you have to also remember what type of situation may happen. So that's why I'm also writing the alternative formulas here for each situation. First, we have the liquidity ratios, which test the liquidity for the firm, how much liquid company or the entity has to pay off the liability. So first is the current ratios. Current ratios is the simple. The formula is the current asset divided by the current liabilities, CA divided by CL. Current asset includes all current assets. Okay. Now, next is the quick ratio. Quick ratio is slightly more conservative than the current ratios. So in quick ratio, we use the cash marketable securities plus receivables. So in current assets, we have four main components, right? So cash marketable securities, receivables, and inventories, right? So we have four components. So here in quick ratio, we will take only three components: cash, marketable securities, and receivables. Now, I'll just give you the basic purpose here. Cash, easily convertible, marketable securities. Remember, these are the marketable securities. Marketable securities, if you need cash, you can easily sell marketable securities. And receivable, you can still ask your debtors to pay you back so that you can settle your liabilities, right? So that's why we have the quick ratio: cash, marketable securities, and plus receivables divided by current liabilities. But by default, the current liabilities, divided by current liabilities. By default, the current assets formula is cash, marketable securities, receivables plus inventories. Here, this means we are simply not considering the inventory part. So in exam, you may also get the situation where you have to calculate, you are provided with the current asset, then inventory, current liability, and you are asked to calculate the quick ratio. So in that case, remember, the current asset minus inventory is also the same thing which we are using in the numerator here. Current asset minus inventory. Okay, so this numerator can be written in two formats: current asset minus inventory, or cash, marketable security, or receivable divided by current liabilities. Then we have the cash ratio. In the cash ratio, we are ignoring the receivables also, because ultimately debtor will decide to, like, if debtor doesn't have enough money, he won't be able to pay you back, right? So if you need cash, you have only two options. Actual two options are this only: the cash and the marketable security. Obviously not the receivable or the inventory part. Inventory ultimately you have to sell. So cash and marketable securities divided by the current liability. Remember, in all three cases, denominator is the same. The change is happening only in the numerator. Okay. Now, the current asset, the alternative formula for this is current asset minus the inventory minus receivables. Remember this. Okay. So for the cash ratio. So here we have the three ratios: current ratio, quick ratio. Quick ratio is also known as the acid test ratio. Remember this, and the cash ratio. Then we have the solvency ratio. Solvency ratio ensures or tries to check the company's solvency. Okay, the relationship of the debt and the equity. So does the company have enough asset to repay all the debts? First, we have the long-term debt to equity ratio, long-term debt to equity ratio. And here, remember, all the ratios are higher the better. All are higher the better. Okay. Now, in the solvency ratio, first we have the long-term debt to equity. Simple, debt divided by equity. But debt is the long-term only. So we'll ignore the short-term debt. Okay. Very simple. We can't directly say lower the better, okay, because ultimately you have to compare it with the peers, okay, so other companies, and based on the industry standard. But still, if it is beyond I'll give the example. Let's say if the debt is 120, total debt is 120 and it is 100, so this is above 1. Above 1, right? Above 1. And then if the reverse is true, like the debt is less than the equity, it is below 1. You have to still compare it with the industry only. Now next is the total debt to equity. So you have the total debt here, and then we have the total equity. So very simple formula, total debt to equity is total debt divided by total equity. So here we are considering the short-term and long-term debt both, and equity is equity only. Now the debt ratio, very important and slightly confusing formula. So this formula is total debt includes short-term and long-term debt divided by total assets. So here in the denominator, in debt ratio, remember in debt ratio, denominator is the total asset and not the total equity. Total asset you have to take. So total debt divided by total assets. This is the formula for the debt ratio, right? And then we have the financial leverage ratio. Financial leverage ratio. So financial leverage ratio is total asset divided by total equity. This ratio tells us like how much equity support, how much the leverage is there with the company. Okay. Now here one more thing, in the debt ratio, if this is above 1, okay, if this is above 1, this means company is in big trouble. Why? Because let's say the debt is 120 and the total assets are 100 only, then company doesn't have enough asset to repay all the debts. Okay, now the company is, in this particular case, company is insolvent practically. Okay, fine. Now next is the financial leverage part. In the financial leverage, it is total asset divided by total equity. Total asset is the outcome of debt plus equity, total debt, total equity. So total asset is equal to debt plus equity divided by equity. This is the alternate formula, debt plus equity divided by equity. So if you are provided with the information on like say debt and equity, and you are asked to calculate the financial leverage, remember you can also use this formula. The main formula is the total asset divided by total equity. Okay, so that's all for this reading number 4, analyzing the balance sheet. Thank you and thank you for watching this video. See you in the next video. Bye bye. Take care.